What's up, guys? Welcome back to my personal finance channel. My name is Kyle DePepe, and today I'm going to go over 5 reasons why options can be much better than stocks. That's right. Now, not in every situation are they better, but this video will focus on these 5 reasons. I hope this is helpful and informative. If it is, be sure to give this video a thumbs up. Subscribe to the channel would really help me out. Would really appreciate it. But let's jump right into it. All right, so let's just run through the 5 things that I'm going to cover today. 1 is risking less money or putting up less capital when you're doing an options trade versus a stock trade. 2, which is sort of associated with that, is leverage. Number 3, the ability to short a stock without shorting a stock. Number 4 is the ability to make money no matter which direction a stock or the market is moving, up, down, sideways, it doesn't matter. Options, you can still make money. And number 5, last but not least, the ability to buy a stock at a price lower than where it's trading at. Stay tuned, bear with me on these. All right, so number 1 and number 2 sort of go together. Because you're getting leverage, you can put up less money. So let's dive into this, right? So the way I'm looking at options and stocks are simply that one call option, or I guess one options contract, whether it's a call or a put, is representative of 100 shares, right? If you buy a call option, it gives you the ability to buy 100 shares of that stock at the strike price at or before the expiration date. So the way I look at it is, let's just take CCIV. Why? Because it's a stock I'm looking at, I guess a SPAC per se, and it's trading right around $30. So let's go ahead and throw up the options chain. And I was looking at some long dated call options, so next January. So if we look at some deep in the money calls, the 20 strike calls are trading at around $15. So you're paying a little over 16% premium for that one call option. However, you only have to put up $1,500 to buy that contract, but you're still getting exposure to 100 shares. And what I mean by that is, if you were to buy the stock and you were to buy 100 shares, right? You want exposure to 100 shares. If you're buying the stock, you have to buy 100 shares. If you do that, you would have to spend $3,000 because $30 times 100 shares, $3,000. Whereas if I buy the call option, I can spend $1,500. So I'm putting less capital at risk by only having $1,500 in the market for this one position. Let's say that CCIV went to 0. Well, I would lose $3,000 in a stock position for 100 shares, whereas I would only lose $1,500 in the one options contract that I bought. So if there's a downside risk, you're only risking what you put into the market. So with the stock, to get 100 shares of exposure, you have to put more money in. Whereas with the call option, you put half as much money in and you still get exposure to those 100 shares. It may have to trade to 35 before you're at break even, but every dollar after that you have more leverage, or you're getting a higher percentage return because you put up less capital to begin with. So let's take that a step further. Let's say the stock went to $90 a share, right? It's an EV company. It was actually trading at like $68, $70 just like, I don't know, 4 or 5 days ago, which is pretty crazy. But the point is, if you bought 100 shares of CCIV and it went to $90, that would be $9,000. You just made a nice $6,000 profit on your $3,000. That's fantastic. But if you bought that one call option for $1,500, half as much, your percentage return would be that much greater. And the reason for that is that 20 strike contract would be worth $70. So your $1,500 investment turned into $7,000, whereas your $3,000 investment turned into $9,000. So let's take it one step further. If you wanted to, you could take that same $3,000 if you wanted to put the same amount of capital at risk in the market and buy 2 call option contracts. So now you would be risking the same amount of capital, but you would have twice the exposure. You would have exposure to 200 shares. So if that same move happened to $90, you would be making $14,000 from that $3,000 investment, or it would be worth a total of $14,000, right? $70 each, or $7,000 for each contract. Whereas with that same $3,000 stock investment, you would have $9,000 total. So you get leverage, you can risk less money and have greater percentage returns. However, you do also have to remember that you can lose 100% of that value or some of that value. But buying a in the money call option, you would only be risking, if the stock stayed at $30 for that full year, you would lose $500 on your $1,500 investment, because that 20 strike contract will only be worth 10 and not 15. Whereas if you bought the stock and just held it, you wouldn't lose anything and you would still just own the stock. So there's obviously trade-offs there, but I like the benefit of being able to put up less money in the market and still have greater potential returns. I can then take, $1,500 in one and $1,500 in another stock and hope that one of them goes up by 3-4x and the other one sits flat or maybe just goes up a little bit. Whereas if I put my $3,000 just into one position instead of two using call options, you don't have exposure to more positions in the market. So that's sort of number 1 and 2 in a nutshell right there as to why I like options and why they can be better and help your portfolio grow and grow faster, because you're getting leverage and you can risk less capital in each position that you take. Now, the next thing, shorting a stock without shorting a stock. So what I mean by that is you can basically buy a put option. Most people don't have the ability to short a stock in their regular account, nor would I advise doing so due to the unlimited risk, right? As the stock goes higher and higher and higher, it can go to infinity, right? It can just keep going up and you would lose more and more money if you were shorting a stock. If you buy a stock, your max loss is that the stock goes to 0, right? So you would just lose 100% of the money you put in. Same thing with buying a put or buying a call. You would lose 100% of that money if it went down, or if the stock just kept going up and you were out of the money on that put or that call, it would just go to 0 by expiration. So you can get exposure to a stock going down by buying a put, which you can't typically do in most accounts, because in order to short a stock, you typically need a margin account. And when you do that, there's just a bunch of other things that come into play, and it's very risky because of that unlimited upside risk. So that's another reason why I like options. I can use them to get the same exposure. If I think a stock is going to go lower, or if I think the market's going to go lower, I can buy a put on something like the SPY, right? The S&P 500 index. I can buy a put on that, get exposure to it going down, maybe buy some insurance if you want to call it that. So I like options from that perspective because it gives me, I guess, more options in the market. I can make money if the market goes down, I can make money if the market goes up, and I can make money if the market goes sideways. So as I said in point number 4, you can make money playing the market in any direction. And the reason for that is because you can buy calls, buy puts, sell calls, sell puts. So this is fantastic, right? If the market isn't doing much, for example, and let's say you own some stock, you can sell call options against that position. Assuming you have 100 shares of the underlying, you could sell one call option and generate some passive income off of that position, even if the stock trades flat. Now let's say you don't want to have stock, right? Because options are so much better. You could just sell a put option. And that gets me into my 5th point, which you can buy a stock at a discount, right? So let's break that down. Let's say you wanted to buy CCIV, for example, and it jumps 30% tomorrow, and you're like, man, I missed out. I would have paid up to maybe $35, but I wouldn't have paid more than that. What you can do is you can go to the options market. You can sell the 35 strike put contract. By selling the 35 strike put contract, you basically just have to make sure that you have the amount of cash in your account if you were to be assigned, or that contract was to be executed and you were put those 100 shares. That means you have to buy them from somebody at $35 a share. Now, granted, you're getting paid to do that. So the stock might be trading at $40 or $50, but let's say you're getting paid $5 for that contract. Well, you collect $500 in your account. So you're getting that income even though you missed out on that upside. And if it never trades below 35, you just move on and go on to the next trade. But if it does trade down, you now not only own the stock at 35, but you still get to keep that $500 that you might have sold that contract for. So what does that mean? Well, it actually lowers your cost basis to $30 a share. So by not chasing the stock and just going out and buying the stock in the open market and selling that put contract, you can A, generate sort of a income or a dividend in that time period until that put contract expires. If the stock never trades lower, you just collect that money and you move on to the next trade. However, if it does trade lower, now you own the stock at an average cost of $35 a share. However, you collected that $500, so your real cost basis is $30 per share, right? You subtract the $5 that you sold that put contract for from the strike price to get your break even, or I guess cost of ownership for those shares. So there's a lot of benefits to trading with options. However, you still have to understand the risk reward profile, all the different dynamics that go into how an option is actually priced versus the price of a stock, which simply trades on supply and demand and people buying and selling the stock. When you look at the option market, you have more than just supply and demand, right? You have the underlying price of the stock, you have time value, you have implied volatility. All of these different factors go into the pricing of an option. And therefore you can actually see an option's value go up, a call option value go up, even if it went down just because of implied volatility, for example. So there's a very different dynamic there, but there are some main benefits, which are leverage, risking less capital, being able to play the market in multiple directions, and getting exposure to trades that you wouldn't normally have access to from simply just buying and selling stocks. So that's why I really like to utilize options in my brokerage account. I use them not only in my regular brokerage account, but also in my Roth IRA. I have a Roth IRA with Fidelity, and they allow options trading. So it really helps me sort of leverage and risk some of that money that's more long-term. I can do speculative out of the money or deep in the money sometimes, call options, but long dated. And that way I can always exercise the call option at a point in time and own the stock for a longer period of time, or I can realize some of those gains, move on to the next trade. Or it also allows me to diversify because, again, I'm putting up less capital for each call option, so I can buy more speculative plays. And if one of those hits a home run and goes up 10,000%, well, then the rest can go to zero and it doesn't matter because I have exposure to 10 instead of 1 or 2 positions if I were to just buy the shares outright. I hope this video was somewhat helpful and made sense. If you don't fully understand options, then this may not make a ton of sense. I do have some other videos on those, so definitely be sure to check those out. But that is why I definitely really like options, like leveraging them, and those are 5 reasons why I think options can be much better, especially when utilized properly compared to just buying stocks. If you enjoyed this, please give it a thumbs up, subscribe to the channel. It would really help me out, would really appreciate it. But until next time, guys, thanks for watching.